Thank you for joining us for another MyWealth webinar, especially on this Masters Thursday, which is always a special time of year for me. Today's guest is Ben Fawcett. He's a senior portfolio manager at Canaccord Genuity. He runs our internal model portfolios, all of which been rated in the top decile, or sorry, top quartile. Um, Pretty exciting. Well, exciting is one word to use, but very topical time of the year of what's been going on globally. Um, Lots to discuss. Ben's got an extremely long track record of outperformance. Been in the investment side well over a decade with his performance. I'll let him talk to you a little bit more about his background. Also on the line is our senior investment advisor, Rahim Samani. My name is Jeff Hunter. For those that don't know, I'm a senior portfolio manager with the Townsend Samani and Hunter Group at Canaccord Genuity. And thanks again for sharing your lunch hour with us. Lots to discuss. If you have any questions, there's a toolbar in the below. Just type them in. We're happy to address them. We're here at your disposal. And then thanks again. And with that, Ben, why don't we just talk a little bit more about your background, how you came about to Canaccord, and just a little bit more about your thought process.
Okay, perfect. Yeah, thanks, Jeff, and thanks for him, and thanks for everyone taking time from your lunch. Um, Going to keep things moving here. There's a ton to cover, as Jeff said. There's a lot going on in the world right now, so I was going to talk from a little bit about some of the politics of what's going on in Iran, elsewhere, impacts on markets, and then also talk about how we invest and the sort of key principles of how we build portfolios, manage risk, and generate returns. Bit about my background. Yeah, a bit older than Jeff made out there, more than 10 years. It's almost 25 years now of managing money professionally. My background is sort of 20 odd years at Canada Life and then Mackenzie Financial, managing multi-million dollar institutional portfolios. So some of that was pension money, some of those are mutual funds. Been doing this a long time, been through a lot of markets. And so that matters, in the last few months when we've been seeing a lot of volatility. I joined Canaccord about 2.5 years ago, so having a lot of fun here, built some new funds, get to do a lot here. It's a great platform, a lot of independence, and can really run with some of the technology. We're heavy users of that. So with that said, I'm going to dig in. I'm going to keep things moving pretty quickly. If you have any questions, you can post them in the chat or reach out to Jeff and he can we'll get your response. So yeah, we'll get things going. Just a quick overview of the internal platform. These are actively managed portfolios. They tend to be around 40 odd stocks in each portfolio. There's a US one, there's a Canadian large cap, Canadian dividend. There's an international, which would be Europe and Japan, a few other areas, as well as emerging markets in the international. And then finally, a couple of composites. One is a North American best ideas portfolio, 50% Canada, 50% US. And there's a new global fund, which has had huge traction. It's around 45% US, 25% Canada, and the rest is international and emerging markets. So it's sort of a one-stop solution, gives you global diversification. Won't go too much into the details of the benefits of these funds at this point, but just broadly, they are broadly diversified geographically and on a sector basis. We use both quantitative and fundamental methods of research. I started out 25 odd years ago in the UK, working in an investment bank on the quantitative research side, working on a hedge fund there too. And then, at other times running multi-billion dollar portfolios, went super deep into the weeds and did a lot of deep fundamental analysis for another 10 years. So, if you ask me what my edge is, it's the ability to bring a lot of the discipline and structure of quantitative techniques and combine that with in-depth knowledge of, any sector, any industry. I've been through the companies and through the weeds. Again, my background is on pension side, where risk management is a huge factor. So these are very much down the fairways. We're very, very careful where we take risk. You have to take risk. That's how you get return. But we make sure we're getting paid for it when we do take risk. And so, yeah, I'll move on. Just a quick summary of how the portfolios have been doing. Obviously, March markets were down, depending on the market between sort of 4 and 8% if you're talking Canada, US, or international. Most of the funds actually, which was good to see, outperform their benchmark. That is what we were sort of gauging our performance in. And year to date, the performance has continued very strong. Canadian funds up 5%. If you're looking at today, you're probably up 7%, 8% in the dividend fund. The US fund has outperformed nicely, and across the board, we've had some great performance. You can also see the longer term performance here. Actually, it's probably this chart's probably a better one to demonstrate that. This is looking at the Morningstar peer group. This is who we're evaluated against and seeing how these funds perform, both year to date, 1 year, 3 year, and 5 year. One being the best quartile, so best 25%, and this is percentile. So, 12th percentile would be in the top 12% of funds. So again, you can see, first and second quartile year to date, the 1 year's first quartile, sorry, 3 year first and 5 year. Not all the funds have a 5 year number now. So, the performance has been excellent. And that again is with very sort of tight, generally below average risk versus the market. So jumping straight into what's happened over the last quarter, like I said, there's a ton to cover here, so I'll keep it out of the time. I've got a lot more to say on a lot of these slides. I'm going to move pretty quickly through them. So again, any questions, you can post them, ask them afterwards, or again, come back to Jeff. Just a quick sort of overview of what happened in the first quarter. No surprise, energy was the big winning sector. This would be the same if you're looking at Canada, US, or Europe. Materials are also quite strong. Just, gold and some of the copper names had a really strong start to the year. Obviously, they sold off in March, but still held on to some of those gains. And utilities, interestingly, and this was across the board, were actually pretty strong. Again, there's two factors here. One is there's an energy component to many utilities. For example, renewables, something we recently added to the portfolio. At the same time as the market became more cautious, it actually started moving more into defensive stocks. And the big negative part for the markets this quarter was technology. I'll show you the US. It's a little more easier to see. Basically, this was a sell-off in software stocks due to AI concerns. The US also had some concerns due to private credit and some of the aspects on the private equity world. So to summarize basically what's been going on in the last 3 months, I mean, like I said, I've been doing this a long time and no market is easy. The last 3 months have been particularly volatile, I suppose. There have been huge cross currents, huge rotations. So there's actually been a lot of activity in the portfolio. And this is sort of the benefit of active management, where we came in at the start of the year, what happened in February was very different. And then obviously you had the sell-off in March. And while we're not turning the whole portfolio there, we're definitely on the margin making adjustments. It's a broad portfolio. We manage risk, but we're making adjustments throughout that so we can sort of recalibrate as the market changes. Three key aspects, and this is why we've had so much volatility. One is AI cross currents. AI has been this big theme. One area in particular has been software. Software is threatened because AI basically is going to allow you to recreate a lot of that code cheaply and quickly and probably make a much better product in some cases. And that, as a result, has resulted in software companies, the valuation that market's willing to pay for them come down a lot just because you've got so much uncertainty what's going to happen in the next 5 to 10 years. So you've had that going on and some big sell-offs there. The other side is there's been questions about private credit. And this is private debt markets, private equity, etc. That's impacted financials. So that was another aspect that as we came to the year, the market started to price in. And then obviously, mid-February, started getting more concerned about what was going on in Iran. The bombing started at the start of March. And normally, geopolitical risks, just the market is not that concerned unless there's a direct way to transmit that into how that impacts the global economy and corporate earnings. And of course, in this case, that was the closure of the Strait of Hormuz, which, the market and certainly the US administration underestimated the ability of the Iranians to do that. And obviously, I don't have to sort of go through all the implications of, 20% of the world's oil basically being cut off, huge amount of its LNG for Europe and Asia being cut off, fertilizer and any other number of products. So that's been the sort of third factor we've had to deal with. So it's been a busy quarter. I'll touch on each of those three factors quickly. There's a lot going on and it's moving quickly. So the current status is we, in theory, have a ceasefire. The last few hours, I think the bombs have stopped, but the first day of the ceasefire didn't look like much of a ceasefire. I saw headlines recently that Israel has agreed to start talking to Hezbollah too. That was one of the aspects. That said, the Straits of Hormuz are largely closed, and anyone that wants to get through there has to get permission from Iran, is the current status. So it's a fluid situation right now. The one big takeaway here is it comes down to asymmetric warfare. We saw this in Ukraine. If you remember, 3.5 years ago now, Putin thought this was going to be a weekend job, just drive the tanks in, he'd have it all done in a few days, and he'd have Ukraine. Like I said, 3.5 years, million casualties. What's changed there is the ability of not a big military force in Ukraine to basically take on a much bigger, better equipped army. And a lot of that has to do with drones and technology, etc. And that's basically what's happened in Iran here. I've been talking about the Strait of Hormuz for 20 years in my career, sort of thing. And, I always knew the Fifth Fleet, US Fifth Fleet, was sitting there in Bahrain right next to the strait. And its sole purpose was to keep the straits open. And so, yeah, Iran could close it for a week or two, but that wouldn't be sustainable. What Iran's proven here is they can close it, and the US isn't willing to sort of get involved, and we haven't seen much interest from the rest of the world either. The reason is you can launch a drone 1,000 miles away, and you can target ships, and those drones don't cost much to make, and you can keep making them, thousands of those every month. On top of that, you've got drone boats, which are being used in this, and you've got drone submarines. So there's increasingly a lot of ways of smaller, less equipped, less funded player can disrupt, someone that's spending 700 billion a year on their military. So that's big geopolitical factor that we have to consider on the Straits of Hormuz going forward. That means you probably want to keep a premium in the oil price going forward, and you also have to consider implications globally. I won't go too much detail here. There's basically this is the negotiations that are going on. There's a number of sort of red lines in both the US 15-point truce proposal and the Iranians countered with a 10-point proposal. Neither side is particularly close, and there are no face-to-face negotiations. My take on how this is going to play out basically will be that this is going to go on for some time. That 2-week ceasefire, if it holds, will be extended several times. This is going to be a bit like the tariff playbook from last year, and probably in June we'll still be talking about this. The key is, can we get oil moving through the straits? The key point here, this slide basically saying there's 20 million barrels there. They need to get out. There's pipelines, etc., that the Saudis have built that can sort of take 5 across land, so that doesn't have to go through the straits. Iran's already said Iraqi oil, 4 million barrels can go through. Iranian oil obviously can keep going through. Put that together, that's about 10 million barrels that should be able to get through, no problem. Still leaves you short 10 million barrels. So bottom line is, the world needs Hormuz, and that oil is going to flow one way or another. We've already seen signs of that, where the Iranians are talking about tolling a ship, say $2 million. If you look at where that oil is going, you can see here in orange, this is all that goes through Hormuz. Where does it go? China's a big part, India's a big part. Both of them have strong relations with Iran and are likely to be able to negotiate passage, in the coming weeks. Some of the other countries, it's a bit more difficult, but at the end of the day, oil is fungible in the sense that if you're not sending oil to Europe, you can say it'll go somewhere else, and someone else will send oil to Europe. So big picture, I don't see $250 oil necessarily, or $500 if you want to compare this to the 1970s type episode, just because the Iranians and Omanis next door will allow the oil through. They're just going to charge a price for it to some extent, or there'll be other political negotiations. As far as sort of the equities standpoint, we actually went overweight energy back in October. The idea here wasn't so much on what's going on from an Iranian standpoint, but this had more to do with just when oil gets below $60 US, the US marginal producer needs, say, $65. Shale declines quickly, and as a result, when oil gets below those levels, the risks are to the upside. We've recently been taking profits on that oil trade. Last week, we took those out. Basically, the way I look at this is what's the futures curve pricing? Right now, it's pricing around $70 US a year out. I actually think that's a bit low. If you're using that $65 US floor as the marginal cost of oil production, you need a risk premium in there for what's going on in Hormuz, because that's not going away. And looking at historic spreads, that can be anywhere up to $20-$25 kind of thing. So in this case, I'd put at least $10 in there. $75 seems like a good oil price to be using going ahead from here. There's obviously inflationary aspects that come with this. I won't touch on them too much. I think a lot of this is going to be fairly transitory. Like I said, $100 oil is quite manageable for the global economy. And I'll speak to sort of, we're just not that reliant on, from an energy intensity standpoint, we were, say, in the 70s or 80s, or even 20 years ago. So just going to run through a few sort of economic pictures, just a broader US picture. Where does this all stack up and where are we right now? Coming into the year is pretty constructive on the outlook. This is inflation. Basically, US inflation is around 2.5%. The yellow bars there is service inflation. US doesn't spend much on goods, mainly it's services. So that's the key aspect. So the inflationary aspects to the US from a higher oil price shouldn't be overstated, I suppose, is the key there. And a lot of these service inflation areas are coming down. The other side that the central banks look at would be inflation, and it's also employment. The employment situation, we're still hovering near full employment, sort of 4.3% unemployment rate. That said, job creation has been very weak, which is interesting when you consider the US economy has actually been very strong. Global economies have been quite strong. So that's something to consider. And of course, there's all the sort of discussions as far as, is this AI related, et cetera, et cetera. If I'm looking at sort of interest rates from a US standpoint, market doesn't think the Fed's going to cut anymore. I still think there's room for a little bit more on that side. Interestingly, the Bank of Canada rates here at 2.25%. The market now expects two increases to 2.75% this year in Canada. Again, I think that's pretty aggressive when you consider, yes, higher oil prices are going to help Canada. Yes, we've got a bit of a commodity boom going on, but there's also issues as far as free trade, et cetera, and pretty high unemployment in Canada at this point. So, I think the Bank of Canada is going to be holding at this 2.25 and potentially could even cut a little bit more if necessary. I'll sort of move past this. The key point here is you're actually seeing manufacturing growth in the US and globally, and a huge part of that is some of this AI capex that's going on. 2% of GDP is the thing. So bringing it back to oil and its impact on the economy, this chart basically shows you how much oil is consumed by the US, China, and EU back in, say, 1970 for each unit of gross domestic product. Obviously, you can see these economies are highly reliant for economic growth on oil price. That's come down massively. So if you want to talk 1970s oil price shock, you'd need $500 oil in today's environment. So it gives you a bit of perspective. $100 oil isn't great for the global economy, but it'll be fine. We had these rates in 2022 and numerous times over the last 20 odd years. Switching to the other key theme here, one is software and AI. We've seen software sell off aggressively due to concerns that it can be replaced by AI in a lot of ways, or it's going to impact pricing. That's something we've been ahead of and continue to sort of believe that, software is at risk and we don't own too much software in the portfolio. I won't go into some of the questionable accounting practices software company use, but needless to say, I think valuations are higher than what they publish. Um, and this comes back to that prior point of mine that, US GDP now, just the spending from the hyperscalers, it's going to impact 2% of US GDP. So we're talking massive amounts of stimulus coming in the sense of what these companies are spending. And most of it's still out of cash flow. There's a bit of balance sheet, debt being issued, but they have pristine balance sheets. So, this is sustainable. Um, and touching on the AI side from the chips to, the NVIDIAs of the world, at the end of the day, I think it's tough to build a new data center just there's a limited amount of electricity out there. So you're still going to have to go back to these chip makers for the next generation of chips, which are just that much more efficient. So, I think the chip story, while it isn't as great as it once was, I think the chips can hold in. So putting that together, we've seen this huge regime change where we're going for asset-light software type companies to, a world where you potentially have an abundance of intelligence, but the physical constraints are far more important, and that's energy, materials, etc. Valuation matters again. For a long time, we were paying 30 times earnings for a company. In this environment, I'm far more inclined to pay 15 times just because I don't know what's going to be happening in the next 5, 10 years. So there's been a big shift as far as how we invest and where we're focused on over the last year. Materials mining stocks, still like those. There just hasn't been any investment for 15 odd years. My former role, I had to spend huge amounts of my time with all the mining companies, energy companies we dealt with, going through carbon footprints, environmental aspects as far as, the investment there. And so many of them could move forward. So we just haven't seen investment in that space in a long term. So I'm still pretty positive on the material side. Gold, I won't get too much into the weeds. I think it's sort of more fair value at these levels, gone slightly underweight on the gold side. And yeah, that's probably enough to say there. This chart is Bitcoin and gold. Blue is a software index. These two move. This is a 5-year chart. These two move together. So, is Bitcoin a store of value or is it another type of gold? This tells me it looks more like software than gold. And like I said, the final of those three aspects. So you got, Iran going on, you've got AI disruption, then you've got concerns over private credit and private equity. There have been some concerns that the private credit could be much like the subprime mortgage crisis that happened in 2008 that led to the great financial crisis. When you sort of go through the numbers and look at the actual scale of it and how that could transmit to the broader economy, yeah, my conclusion is that's not going to happen. It's an impact for some financials, some insurance companies, some banks, but it's not a concern for the broader economy. So, if I'm putting it together as far as sort of the economic outlook, from Canada, actually, pretty constructive still. So fiscal stimulus from the last budget is going to be considerable. That should start hitting the economy somewhere around mid-year. Bank of Canada has been cutting rates. They were early. So we're, like I said, 2.25. They could go lower if necessary, but there's a delayed effect. So lower rates, that's going to be bleeding into the Canadian economy. You got commodities strong, so that's always great for the Canadian economy. Foreign investment should be coming on the back of that. U.S. economy still, I think, is going to be fine. So that always is a big determinant of where Canada goes. Global economy, I think, is decent too. The big issue is the CUSMA negotiation, the free trading negotiations coming up in the middle of the year. And, it's pretty tough to sort of tell where that's going. My initial view had been that that's getting pretty close to midterm elections. And if you make big changes, you need to go back to Congress. And so the US administration wouldn't want to do that, say, in July of this year. After recent activity by the US administration, you can't bet on anything at this stage. So that'd be my one concern on the Canadian front. US, a little bit less positive on. Part of that's just valuations. And the Fed hasn't cut rates to the same extent there. And you also have midterm elections, and there could be a bit of instability around that. Though it was quite comforting to see the Supreme Court come back and just strike down some of the legislation around, or the executive orders around, um, tariffs. It shows there's certain independence there. Finally, one of my favorite areas is international, and they've been cutting rates for 2 years, so you're seeing real economic growth there. At the same time, got a ton of government spending, which is always great for economies. And be it Germany, Japan, you name it, valuations are a lot more reasonable. On top of that, there's a real self-help story. A lot of these companies haven't been run well historically. What we're seeing is a lot more US activist investors. Buffett, for example, just has been adding to Japan and did so last week again with a new investment in Tokyo Marine. And I dig into the weeds of a lot of these companies and go through the guts of them, and I'm seeing real improvement. That's a long story, but it is step by step. There's something to be optimistic about. So, pecking order would be international first, Canada, and then US. So on that note, one more macro slide here, actually, but this ties in with a new fund we just launched. It's a global focus fund. There's a key consideration you need to make when you look at global investing, I suppose. What you have in this chart here is the total market cap of all the markets in the world back in 1990, for example. So the black line here is all developed markets ex-US. The blue line would be the US, and then you got emerging markets down here. What you can see is all other markets were at 60% weight, and they've gone down to 25% weight now. Meanwhile, the US has done the opposite to some extent. 2 points here. One is things change. So just because the US is 65 or 70% of global markets doesn't mean that's always going to be the case. These things change. The second is the US is very tech focused. If you go through the sectors and actually sort of add up all the different companies, you're over 50% tech focused. It's not only tech focused, but you're in a world where you've got this massive AI transition underway right now. And it's pretty binary. We just don't know where it's going to go, who the winners are going to be, who the losers are going to be. So if you own a global fund, and you could find yourself 70% invested in the US, because that's where the global indices say you should be. At the same time, that's hugely tech focused. And so that's just not diversified. So what we've done is we've created a global portfolio, and this is based on the Canadian focus portfolio we've had for 5+ years, same with the US focus portfolio and the international portfolio. And we've reweighted them to create a one-stop solution that's just nicely diversified, nicely balanced. So the US is 40 to 45% of that, as opposed to 65 to 70% like a lot of other global funds. It's got a 25% allocation to Canada, and then the balance is Europe, Japan, emerging markets. Emerging markets right now, a lot of the Latin American countries look great. We've got a number of investments in Brazil, Mexico, etc. Those are also oil exporting countries, so they've held up quite well in the recent sort of volatility. And the final sort of bit on the global here, and I won't go through all the numbers here, but here we're looking at risk versus return. Like I said, you only want to take risk if you're going to get paid for it. And that's where we spend a lot of time thinking about how we build these portfolios. And it's too often an area I find others don't. They'll take on a lot of risk and they'll go for some big return. But if you actually start factoring the two, the balance isn't there. What you have here is an ETF and also the global peer group. And we created a composite of those three funds that have been in existence for a while and just looked at the returns. So returns here on this axis higher over the last 5 years. Likewise, the volatility is actually lower than these two funds. So, historically, this composite is giving you higher returns, lower volatility. Just in the last few minutes, and I'll take another 5 minutes here, and then I'll wrap things up if anyone has any questions. Just want to talk a little bit more about how we actually build these portfolios. There's 7 sort of key principles, if you like. These are the principles, how do we actually pick stocks? How do we construct portfolios? How do we manage risk? The key aspect is, like I said, been doing this 25 years now. And what I've noticed is most of the really big mistakes aren't in analyticals. It's not because someone didn't know their stuff or didn't build the right spreadsheet. It's due to behavior. You have a volatile market, or you have a narrative that's hot, or someone gets really convicted on something. They make a big move, they get into trouble, and that's where you get lasting damage done to a portfolio. Instead, what we have here is we have structure and discipline. Big believer in that. That's what keeps you from making those behavioral mistakes. This is the block and tackle, how you get portfolio management right. So what we have created is 7 general rules that we use for these portfolios. Rules that apply when markets are calm and when they're not, like the last quarter. Rules that limit permanent loss and reduce avoidable volatility. Give a lot of thought to the volatility risk side of things. And then, rules that allow you to basically stay put and allow your capital to compound over time. These rules aren't set up for any specific type of market. They're broad. They're designed to work in different types of markets. So I'm going to run through those rules quickly. Maybe another call sometime we can really dig deep into them. But the first one is building portfolios, not forecasts. Too often everyone says, what are your best ideas? Put those in a portfolio, and there you go. We don't do that. Best ideas definitely end up in the portfolio, but we start with a holistic lens. We're trying to build something that's balanced. We're trying to build something that's going to work in March when energy was running and the rest of the market was selling off, or that's going to work in February when a lot of, gold was working, but software was falling, or in January when cyclical stocks were doing really well in transports, for example. So we've had 3 really strong narratives in 3 months there. And if you were leaning too far one way or the other, you would have had a really bumpy ride. What we've done is build a broad portfolio, and we're going to pick the best stocks in each of those areas. And so the portfolio it's robust in those sort of environments. The second aspect is the all-weather portfolio versus the all-or-nothing portfolio. Hold meaningful positions, but make sure they're not so large that one stock or decision defines the results. You don't want too many stocks in a portfolio because then no one stock really makes a difference. You put all that work in and you really don't get benefit even if it works. The other side is you don't want 1, 2, or 3 positions that define where you go. Here's the stat. A good portfolio manager, and this is a good one, well below above average, is right 53% of the time on individual stocks they pick. So the reality is a good portfolio manager is going to be wrong a lot of the time. You need to build a portfolio where you've got a lot of different bets or investments going, acknowledging that you are going to be wrong on a lot of them. So that's why you don't 1, 2, or 3, because it's really easy for those 3, for example, to be wrong at any given point, in which case you're going to be hurt. Managing risk to enable better long-term returns is the third one. This is how do you assemble that portfolio? Do you have all the stocks moving in the same direction? If you can get stocks that behave differently in different markets, they can actually basically X out some of that volatility. It's the correlation between the different stocks. And if you can do that, you can actually build a smoother return profile than the market as a whole. That's great because that allows you to hold on, stay in the market, and get the benefits of that long-term compounding. Fourth one is market timing rarely works. 2 points here. One is market timing is really, really tough to get right. And the second point is if you make a big cash call, let's say you go 20% cash because I'm worried about what's going to happen in the market here. The reality, back to my prior point, is you're only right 52, 53% of the time. That cash call is going to be wrong a lot of the time. And the bigger factor is, let's say you decide, I'm going to sell to get out. And we've seen this in lots of recent markets. You start feeling good about yourself because the market's going, you're like going down, you're like, I got it right. What always happens, though, is the market turns at a certain point when the situation still looks pretty dark and still looks pretty bleak. The market looks forward and it sees there's a turnaround here. And, I can look at last March and we'll see if this March is going to be the same. But the point is that you don't know when to buy back in. And generally people don't get the sell and the buy right. So you end up missing out on those critical days. So it's best to just build a portfolio that's robust and you can stick with and you have confidence in and just stay the course. Number 5 is evidence over ego. This is where decisions have to be grounded in evidence. This isn't a gut feel. This isn't instinct. This is back testing. We quantify everything. We quantify how we think of stocks, how we think of the world, and we test those strategies over 20, 30 years of data. So when we get into different environments, we know how the portfolio is supposed to behave. We can make adjustments as necessary. This isn't my gut says today we got to do this or we got to do that. Consistency beats brilliance is the sixth one. Um, Again, don't make just, one or two big bold calls. It's about hitting singles. You got 40 stocks in the portfolio. You want each of them to make their contribution. The big thing here to think about is, those big calls are great when they go right. And sometimes you get a couple in a row and you'll have huge numbers kind of thing. But at the same time, you're going to have a situation where those big bets go wrong a couple times, maybe three times. And if you have three big bets go wrong, you can find yourself in a really uncomfortable situation. It's at that point that people often switch up how they invest. So they know if they have a fourth bad call, there's real trouble, sort of thing. So you say, okay, I'm going to take it easy. I'm going to bring in all my bets. And those are the times when you just have to keep doing the same thing. So if your bets are too big, you can't stick to your game plan and your investment strategy. And the final one is know where your edge comes from. I can sit here and talk to you for an hour about you name it, what stock kind of thing. Doesn't mean I have an edge on that individual one. I just have a view. You really have to know where your edge is. And that's critical. Markets are incredibly competitive. And so know where your edge is, and you have to really leverage that, lean into that. I think I'll probably leave it there. Just this is some attribution going through how the portfolios did in the first quarter. As you can see, the Canadian focus outperformed by about 100 base, about 1%. US focus by almost 2%, and the international obviously was up, almost 6% sort of thing. So, strong performance Q1 sort of continuing. So, with that, I think that's probably a good spot to hand it back to you, Jeff.
I think just you flipped over a nice slide there too on the overweights.
Yeah,
If you just want to touch with that, and for those in the audience, there's a Q&A button. Anything touched on this or any sort of macro commentary, feel free to reach out and by all means, Raheem and I are available afterwards to discuss as well. But yeah, if you just want to talk about allocations and sensitivities right now, just
yeah.
briefly.
Yeah, no, definitely. This is a slide for that new global total equity portfolio. So it shows geographic and sort of key assets, how we're focused right now. As I touched on from that positioning, US would be our least favorite at this point. I'm not super negative on it. I think, like I said, you've got $1 trillion of AI investment bleeding into the US economy. You've got the big, beautiful bill, and a central bank that could still cut rates. So there's a lot going on in the US that's good. It's just some of the valuations are high. Some of the Mag 7s, I think those businesses have changed. They went from being these software companies that generated huge amounts of excess capital or cash to companies that now have to just take that cash and reinvest it back in data centers and chips. And that's just not as attractive business is the bottom line. So those companies are going to keep growing, but they're just not going to have cash that they can give back to shareholders. And that means they should trade at lower valuations. So the US, not hugely positive on versus rest of the world, but in absolute, I think you'll still get a decent return. Canada, positive on. Like I said, you've got government spending, you've got interest rate benefits, and you've got commodities doing well. Europe too, really like the self-help side as far as improvement in the fundamentals of some of those companies. Lots of government spending, low interest rates. I think this is a big moment for the next, 5+ years for Europe and Japan. When I start looking through these companies, how badly run they were, and I'm seeing real changes happen there. Emerging markets pretty positive too, but you got to be very careful where you go. The third emerging market indices right now is South Korea and Taiwan. Taiwan is basically TSM is half that index. South Korea, you've got SK Hynix, a chip company. You've got Samsung, huge components of those indices. So there's a portion of emerging markets now that's basically a chips play, same as the Nasdaq. On the other hand, you've got other parts of it that would be, India, or in particular, like I said, I really like the Latin America, Brazil, Mexico, and areas like that. Style wise, we're leaning value. As I mentioned, there's a lot of uncertainty out there with technology. Like commodity companies, they tend to be more value oriented, neutral on growth, and then some of your quality. These are your asset light type software companies, companies that have huge intellectual property. In an AI world, if intellectual property, and I look at Thomson Reuters as an example here, if that's your support, you can be disintermediated by AI increasingly if I look at what's going on with this technology. So that's a real risk. Having solid physical assets, that's a real moat. That's defensible business. That would speak to more cyclical stocks. The defensive side of the portfolio, we definitely had them. They were very useful in March. So, we'll have utilities, we'll have staples. Healthcare, I actually like, and that tends to be a defensive area. Some of the pharmaceuticals, some of the biotech, I think there's some interesting stories there. Um, and then, as far as the different assets, gold, sort of more neutral on, but generally mining companies and materials more positive. Energy, we were very positive. I think they've sort of run, need to settle out. We've gone back to neutral. But like I said, I think the long-term oil price is still low. I'd still be looking 75 bucks at least. Canadian dollar, I think, is probably low, and the upside there, US dollar, less positive on. Specifically from a positioning standpoint, again, on the material side, like I said, mining, copper has hit a bit of a soft spot. The long-term story is really good. We're early in the year. All the copper mines come out with plans as far as how much they're going to produce. And as the year goes on, they won't hit those plans. These are big mines and they always have operational issues. So, the story gets better generally as you go through the year. Fertilizers, still like a lot of areas there that we did from nitrogen, but potash through nutrient is good, mosaic is good. Industrials, airlines, again, we think gold prices are going to be a bit higher, so that's not great for airlines. It's about a third of their structure. But we also do own some transports, rails and trucking companies, just because there's a freight cycle and they've had a really tough time for 3 years, and I think they're coming out of that. Utilities, definitely there on that. I think energy demand is strong and it's going to continue to be strong. Same with some of the renewables. We've been moving back into some of those stocks which had been a bit beaten up. Hormuz sort of reminds everyone that you need a backup plan. Banks, we've been moving underweight on that, just where we are in the interest rate cycle, basically. You want to own banks when interest rates are coming down. It means their margins are expanding. We're probably kind of there everywhere but the US. Insurance companies, not so positive on. A lot of them invest in private equity and private credit. There's some risks around that. On the technology standpoint, software companies have been beaten up, but yeah, I just don't know where this ends, and I'm certainly not stepping in at this point. I think there's real risk to these business models, and some of the accounting, like I said, is questionable. The chips were more neutral on. I think they hold in. Consumer discretionaries, again, that K-shaped US economy where you got a segment that's doing really well and a large segment that isn't. So you might want discount stores, and you pair that with not quite luxury goods, but Ralph Lauren or some of those types of names. And then, finally, communication services, Canadian telcos. There's a bit of a price war going on right now. Quebecor and Free Mobile are leading the charge on that one. So it makes for a tough environment. Plus, you've got zero population growth in Canada right now, which again means they don't have any new subscribers. So a flavor of what's going on in the portfolio.
Perfect. Well, hey, thank you for that, and thanks for your time today. For those of you listening here, we'll record it and we'll send it back to you. If you have any questions, feel free to comment, sorry, to reach out to Raheem or myself. More than happy to go in depth with you and chat further. With that, thanks very much, everyone.
Thanks, everyone. Thanks, Jeff from Rahim. Cheers, guys.